the secret engine behind every dollar. It began as a question most people never thought to ask. How does money move? Not in your hands or your wallet, but beneath the surface of the entire economy. And what hidden machine keeps that flow alive when everything else starts to fail? To understand why this story still matters, we need to return to a moment when America's financial system was growing too fast for its own infrastructure. Trade expanded across states. Banks multiplied, each issuing their own notes. Businesses depended on credit that stretched farther than the reserves backing it. The country was modernizing, but its financial wiring was dangerously outdated. Beneath the surface, the system pulsed with risk. This was a world in which a new idea took shape, an invisible mechanism meant to stabilize the chaos, a network that would balance the flow of money between banks, ensure payments cleared, and prevent small disruptions from becoming national collapses. It wasn't glamorous. It wasn't political theater, but it would become one of the most important forces in American finance. At first, the concept seemed almost too simple. Banks needed a reliable way to settle debts with one another. As commerce expanded, the old methods failed under the weight of growing transactions. Delays spread, reserves fluctuated, and every missed payment sent ripples of uncertainty through local economies. To fix it, bankers crafted a coordinated system, an engine that worked quietly but constantly, smoothing the movement of money across the nation. The early version of this engine was fragile. It relied on trust between institutions that often viewed one another as rivals. Still, the idea gained traction. Payments became predictable. Cities grew more confident. Trade accelerated. But beneath the optimism, a deeper truth emerged. This new structure was only as strong as the banks that fed it, and some of them were far weaker than they appeared. Cracks began to form. A delay in one region caused strain in another. A sudden shortage of reserves forced banks to scramble for liquidity. And while the public rarely noticed these disruptions, those working behind the scenes felt the tension building. The engine was young, untested, and vulnerable to a single failure. Even in these early moments, the stakes were immense. Because once you create a system that the entire economy depends on, its collapse can bring everything down with it. The idea that once promised stability now carried the weight of a hidden risk, one that was slowly growing stronger, waiting for its moment to reveal itself. The hidden risk revealed itself in small but unsettling ways. A missed transfer here, a delayed settlement there. Most people never notice these glitches, but inside the banking world, they were warnings, signals that the engine holding everything together was under strain. And strain, in a system built entirely on trust, can be deadly. As transactions increased, the engine struggled to keep pace. Banks that had once operated independently now relied heavily on the network to survive daily operations. A single shortage of reserves could trigger a chain reaction. When one bank stumbled, another felt the shock, and the institutions caught in the middle were forced to scramble, borrowing from wherever they could just to stay afloat until the next day's settlements. The tension grew thicker. Newspapers hinted at instability, though their words were careful and measured. Officials offered reassurances, but behind polished statements, private letters and closed-door conversations revealed something different: fear. Bank presidents wrote of sudden liquidity shortages. State officials warned of regional disruptions, and traders whispered that a failure in one major city could set off a cascade unlike anything the nation had seen. Meanwhile, competition between banks intensified the pressure. Some institutions stretched their credit to gain customers, confident the engine would absorb the strain. Others hoarded reserves to protect themselves, unintentionally weakening the very system they depended on. The uneven behavior amplified vulnerabilities. What looked like stability from the outside felt increasingly like a fragile illusion from within. The public felt the first signs of trouble as credit tightened. Merchants were denied loans they once received easily. Businesses delayed shipments, uncertain whether payments would clear. Families noticed subtle but unsettling changes. Slower transactions, strange hesitation from tellers, fewer notes in circulation. These small disruptions hinted at a deeper imbalance, one the public couldn't yet name. Political leaders argued over the cause. Some blamed irresponsible banks. Others blamed outdated laws. A few insisted the system was strong, and merely experiencing natural growing pains. But none could deny that confidence was fading. And confidence, once weakened, rarely returns without a price. As pressure mounted, the early conflict took shape. Banks quietly prepared for potential failure by tightening credit and protecting their reserves. Smaller institutions feared being swallowed by the chaos. Larger ones feared being blamed for it. And as each bank made decisions to protect itself, the engine that connected them all grew weaker. The nation was inching toward a moment of reckoning. Problems no longer hid in back rooms or private ledgers. They were spreading, gathering momentum, and threatening to expose just how vulnerable the financial network had become. The question now was simple, but terrifying. What happens when the engine behind every dollar begins to falter? The moment the engine began to falter, the entire financial system felt the shock. What had once been a quiet set of behind-the-scenes problems surged into public view with an intensity no one could ignore. A single missettlement in one major city triggered delays across the network. Banks froze transactions, unsure whether incoming payments would arrive. And suddenly, the invisible machinery that kept the nation's money flowing shuddered under the weight of its own design. Panic rippled through the system. Merchants found their payments delayed without explanation. Businesses that depended on daily credit discovered their accounts temporarily locked. Even wealthy institutions felt the tension as expected transfers failed to appear. Every missing dollar created uncertainty, and every moment of uncertainty fed a growing fear that something fundamental had broken. Inside the banks, the emotional pressure deepened. Managers pored over ledgers, searching for discrepancies. Couriers rushed across city streets carrying urgent notes. Telegraph lines hummed with messages demanding clarity. But clarity never arrived. The situation shifted too quickly, and with every hour, trust, already stretched thin, eroded even further. The conflict between institutions intensified. Larger banks accused smaller ones of reckless lending. Smaller banks accused larger ones of manipulative tactics. Politicians pointed fingers in every direction, desperate to find a villain or flaw that could explain the chaos spiraling outward. But beneath all the accusations, one truth became impossible to ignore. The system had grown too interconnected for any single failure to remain isolated. As the crisis deepened, rumors filled a vacuum left by uncertainty. Some claimed that a major regional bank was on the brink of collapse. Others insisted that reserves had run out entirely. Lines formed outside local branches as citizens demanded their money. Each withdrawal worsening the strain on already fragile institutions. Tellers avoided eye contact. Managers whispered behind closed doors. The fear was contagious, spreading faster than any fact could counter. The emotional weight reached its peak when multiple banks halted withdrawals altogether. Officially, they called it a temporary measure. Unofficially, it was a sign of surrender. Without the engine processing settlements, without the steady flow of reserves, without confidence holding everything together, even the strongest institutions were exposed. A system built on interconnected trust had become a system collapsing under interconnected fear. The build-up toward the crisis's peak was unmistakable. People who had always trusted the banks now questioned every statement, every reassurance, every promise. Business owners braced for losses. Families withdrew their savings and hid them at home. And all the while, the engine that once silently powered the economy now sputtered, sending tremors through every corner of American life. What had begun as a technical solution had become the source of a nationwide emergency. And in the gathering silence between each new shock, the country could sense it. The climax was near, and whatever happened next would alter the shape of the financial world for years to come. The climax arrived with a quiet, devastating finality. After weeks of mounting tension, the engine that once powered the nation's financial heartbeat simply failed to complete a critical round of settlements. The breakdown was small in appearance, a mistransfer, an unbalanced ledger, but massive in consequence. It signaled what everyone feared. The system had reached its limit. Banks across the country froze operations. Doors stayed shut. Notices were posted on windows in hurried handwriting, promising that services would resume soon, though no one truly believed it. Without the engine to settle payments, Every institution became vulnerable. They couldn't trust the money owed to them, and they couldn't honor the money their customers demanded. The entire structure, built on smooth, unseen coordination, had collapsed under its own weight. The climax of the crisis wasn't a loud explosion, but a dawning realization. The nation understood that an invisible mechanism had held its prosperity together, and that without it, commerce could not function. Goods stalled in warehouses. Factories halted production. Even basic transactions became tangled in uncertainty. The economy slowed to a crawl as the backbone of financial trust disintegrated. In the aftermath, the country confronted an uncomfortable truth. A system designed to create stability had, through its complexity, introduced a new vulnerability. Leaders rushed to propose reforms. Bankers argued for clearer rules, better reserves, stronger oversight, and citizens, shaken by the sudden collapse, demanded a safer foundation for their livelihoods. Reflection spread across the nation. People realized that financial systems are never just technical structures. They are living networks of trust, cooperation, and fragile interdependence. When one part fails, the consequences ripple outward. What happened in those days was more than a crisis. It was a revelation about the hidden machinery that powers every transaction, every loan, every dream built on the promise of economic stability. The lesson endured. Stability is never guaranteed. It must be built, rebuilt, and protected through choices that acknowledge not just growth, but fragility. The engine that had once held a nation together now became a symbol of why every financial system must evolve, adapt, and prepare for the unexpected. Subscribe to join the journey.